Welcome, everyone. My name is Vishal Teckchandani, and today we close the books on another reporting season to discuss some of the biggest movers and shakers this week and some of the key calls emerging from August 2026. I'm joined by James Gerrish, Portfolio Manager at Market Partners. James, it's so great to see you again. Welcome.
Thanks for having me, mate, on the back end of reporting season. It's been a busy month in markets, but we get a better handle on what's playing out in the Aussie economy, I guess.
Absolutely. And it's been an explosive season for share price moves. Why don't we start with WiseTech, James? Little uncontroversial growth stock. The share price fell from about $45 to $40 after reporting results. Now, interestingly, it is trading on 20 times forward earnings, an extraordinary multiple for a company that's traded as a high growth tech stock. Now, for viewers who remember in last week's earnings season wrap, Henry Jennings called CSL too damn cheap. It got to a point where it was too damn cheap. James, when you look at WiseTech, 20 times earnings, completely beaten down, US tech sector, US software sector rallying nearly back to record highs. Is this a too damn cheap moment for WiseTech?
Yeah, a couple of interesting points there. So obviously the result was taken negatively this week, the stock down a fair way. There was a lot in the market thinking this was going to be a really strong result. I think I read a note from Coppo calling this, expecting this to be a share price rally of 20% post this result. It's gone the other way. I think the main, if we think about FY26, there's two parts to the business. There's obviously CargoWise, which is their main logistics platform, and then there's the acquisition of E2Open that happened during the period. So that's adding to their top line growth, which came in a really strong 79%. But if you look at CargoWise, the actual top line of CargoWise grew at 11%, which was lower than expected. So market was about 15% growth. So if you think about this going forward, their guidance for the business going forward was 6 to 10% growth, and that was, the market was looking for 10% growth. So when your question was around, is it too damn cheap? Well, the growth in this business has slowed, so it's not the explosive growth that you've gotten in the past, but they're becoming more profitable. So in FY26 result, they did a good job of stripping out costs. They've obviously sacked a lot of people. They're utilising AI more, and that's reducing the cost side. And then in terms of their guidance for FY27, that's shining through in terms of that. So they're actually, their earnings are slightly better, top line growth slightly lower than what the market expected. But I actually think it is good value at this current point in time. If you look through all the noise that's played out over the past 12 months, and there's been a heap of it, let's be honest, then I think there is still a strong foundation for WiseTech to grow at more steady rates from here, and also focus more on the earnings side. So that's why the earnings multiple is looking better than it once was, Fish.
Okay. I'll be curious about your sentiment for the next one. So let's talk about Endeavour Group, owner of Dan Murphy's, BWS, and a huge hotels business. But it also faces what looks like a generational shift away from alcohol. Now, this company is popular among our viewers because of the dividend. A Flinders University study, I looked at this before doing my research on Endeavour, found that Gen Z are nearly 20 times more likely to abstain from booze than baby boomers. So if you look at Endeavour Group, where it is now and past these results, is liquor and hotels really a space you want to be in? What are your thoughts?
So when you think about investing, you want to, I guess, buy stocks with the greatest tailwinds and trying to avoid stocks with, the greatest headwinds. And right now, there's probably, two trains of thought in Endeavour. It's on the cheaper side, although it's still trading on an elevated multiple at the moment because their profits are depressed because they're spending money on a turnaround. So there's the valuation side, but then there's the future, the growth side. So to me, I think you made some really good points about the lower levels of drinking. That's a structural trend. So they've obviously got bottle shops, Endeavour, and they've got hotels. So both of those areas have structural headwinds in my view. I don't think this is a cyclical thematic. So we're right here, in the low threes. To me, Endeavour is probably 50-50. Like I get where they're going with the turnaround. I think turning something this significant, like the size of this business around, in the against the headwinds that we're seeing from a structural standpoint, I think it's going to continue to be a long challenge. So, when you look at all the stocks on the ASX and globally now that you've got access to, do I think Endeavour's a fantastic buy at these current levels? I wouldn't say so. I think we're probably 6 months too early. So the turnaround is gaining some traction. You look at sales momentum was okay at the start FY27. So it's okay at these current point in time. I don't think I'd be buying it yet. I'd probably be waiting for that turnaround to get some traction, in 6 months' time or so. Probably at the next set of results, the first half of 27 results, you'd probably go back and look at Endeavour.
Okay, fair enough. Let's move on to SiteMinder. So hotels booking engine, weaker growth than the market expected. What do you make of this company's prospects from here?
Yeah, this was if you go back a couple of years, this is one of the hottest IPOs that came on the ASX. I think it was Macquarie that listed this. And then obviously you've had all the AI and software, and right at the point where they're monetizing their huge user base. So they've got a huge volume of hotels globally on their platform, and then along came AI, and there's going to be a disruption around that. I think that the earnings I looked through their earnings line in FY26, and they were all pretty much in line to slightly weak, but that's not the key here. The key here is around the growth in average reoccurring revenue. So they've always hung their hat on that they'd be able to achieve 30% growth in ARR over time. They've stepped back from that number in this result. So they're now guiding to 20 to 29% growth, which is probably achievable. They're also, moving towards or emphasizing the trend that other software companies have done. So maybe a little bit less growth, but maybe a little bit more profitability moving forward is probably the focus here. So, down around these, it's trading around 3.15 last time I looked. I think this is a really interesting stock to look at now, from where the market had growth rates at really high levels. The market has recalibrated their expectations. The company's recalibrated the market expectations for them. The stock price has reacted to it. But I think at these levels, it actually looks like a really interesting proposition. So I actually like that one here, Vish.
Okay, and interesting you say that. There seems to be a common thread with these high growth companies. It's not just the growth rate, it's the profitability, the quality of the profitability. So interesting thing for shareholders to watch. Let's turn to resources. So Sandfire Resources, huge month for this company, up around 20%. FY earnings, wow, up 214%. Profits up 300%. Company moved to net cash, rewarded shareholders with a 35-cent fully franked dividend. But is the risk with this company that it's ultimately a one-trick pony, 70% exposed to the copper price? If the copper price turns down, maybe those fortunes reverse. What's your take on Sandfire?
Yeah, totally. If you own Sandfire, which we do, you've got to have a positive view on the copper price. The commodity equities will follow the commodity price itself over time. So you start with the copper price. So we're particularly bullish on copper over the medium term. I think you've got these two intersecting dynamics. So obviously electrification globally has a high intensity or use of copper, and then we've got the AI thematic that's just exploding, and that's the infrastructure associated with that requires a lot of copper. You then think on the supply side. So there's, when you think about commodities, there's always two sides of it. There's demand, which I think we've got, the demand is going to be strong over the coming years, and then supply is going to be constrained over that time frame. So the global copper market moves in the net deficit. So copper prices should track higher. And then Sandfire's got a couple of great assets that are now producing very well. So operationally, in years gone by, they've had a few challenges operationally, but they've really got their book in order operationally. Then they've got the copper price tailwind. They're producing a lot of free cash flow. They've announced their a 35-cent divvy at the result. So that shows how strong they are from a balance sheet point of view. So I really like Sandfire. I think it's probably a little bit expensive at this point in time. It has broken out to new highs this month, and it's been a phenomenal performer for us over the last couple of years. I'd probably, you probably wait to buy it on a dip, but it's definitely one of the copper plays here in Australia that we're going to continue to own over the coming years, Vish.
Okay, along with copper. Those are the four stocks I wanted to talk about, James. Is there any other key companies that you wanted to highlight?
It's been an interesting reporting season. So collectively, like most of overall at the index level, we've had good growth. So EPS is growing circa 11%, which is, you take that on the numbers that we've seen in recent years, but it's all being underpinned by what's playing out in the mining sector. So the mining stocks are really driving that. So if I focus on, some of the mining stocks, we touched it on Sandfire. They had a great set of results. Pilbara. So the lithium space has got us interested again at the moment. And if I think about the stock, the most recent acquisition we've made in our large cap growth strategy, that's buying Pilbara Minerals. We obviously had a big run up on the upside in lithium. Then lithium prices came back as the market got concerned about new production or mothball production coming back online. I think that's worked through the lithium companies at the moment, and we found a good base in lithium stock. So I thought Pilbara's result was a strong one this week. South32 would be another one I'd call out. So, they've made a big announcement to focus more heavily on the copper side, selling some of their alumina assets, aluminium assets, to focus on higher growth copper. And I think that's a really sensible strategy for South32. Their result was really good this week as well. So I guess the key trend I'd say is, there's a lot of sogginess in the Aussie economy. So you want to be sort of focusing on areas of the market that are not influenced as heavily by the ebbs and flows of the Australian economy, the Australian consumer, and focus on things that are performing operationally now, but importantly, they've got tailwinds for the future. So I don't want to harp too much, about commodities, but I think that's a really, we're overweight commodities in our portfolios, and I think that's a good place to be at the moment. And then, what have we gotten wrong through this reporting season? The last stock we sold after results was JB Hi-Fi. My view was that the consumer was starting to, the market was starting to get too negative on the consumer. But we simply haven't really seen that in these results yet. The consumer's still constricted with higher rates, cost of living, and all of the things that we know about. So, consumer discretionary names are still under a little bit of pressure. And then on the other side, some of the property stocks are doing okay, some are doing not as well. And it's, I think the property area is an accumulator at these current levels. So a lot to take out of reporting, Vish.
Okay. August 2026 was interesting, James. If I think about some of the commentators, Henry Jennings pointed out something good, was that you've had almost these structural re-ratings of large caps. They're almost trading like small caps in a way. CSL up how much ever it went up in a day, more than 10%. For you, what's your verdict on this reporting season? If you had one line or one word for it.
Yeah, so probably a couple of things. The stocks that have moved most are those that had been kicked to the curb and the market had totally disregarded. So CSL, Cochlear fit into that bill. So when they just meet expectations and the stocks start rallying, then you've got all these very much benchmark aware money that can't not own a large cap Aussie stock that is rallying strongly. So one of the best things to be is underweight or have no weight in CSL and Cochlear over the 12 months prior. But then you've got to be quick to rejig those weightings. So I don't think the results themselves were that good, but they're obviously benefiting from index aware investors piling into them. I think FY27 trading updates have been more influential than FY26 results. So obviously the market's a forward-looking beast, and we want to see what's playing out here and now, and that's how you really get a good handle on how companies are performing. The other trend is that you need to stay with strength, and I'd highlight the commodity sector again. The commodity sector to me looks particularly strong at the moment, and I don't see any reason why that'll not continue to be strong over the coming 12 months. And then I think you've got to be, I saw enough in some of the property results to think that sector is starting to find a base. So, we had the likes of Mirvac and Stockland who reported, are expecting some growth in FY27 when the market was expecting no growth at all. So I think that the market here in Australia is very dominated by the resources. That's what's underpinning the strength, and it's very patchy elsewhere. The other thing I would be interesting here is that everyone's now net negative, the banks, and I get it. Loan applications have come off the boil pretty sharply, but it is stemming from the budget, and it is stemming from some pretty significant tax changes. So that'll take time to work through. But I'd sort of caution against going super negative the banks after they've all dropped, bar ANZ. By circa 20%. So the banks have been another one I'd look at the moment. And the expectation in the banks, so just quickly, Westpac would be our preferred pick at these current levels, just in terms of the expectations around a special dividend coming up in November. They've got excess capital on their balance sheet. So that to me looks like an interesting income play. So tying back into a stock we spoke about earlier, Endeavour Group, I'd much prefer to buy Westpac here than Endeavour Group on the expectation or the possibility that they'll pay a special at the next time they report. So all in all, reporting season was okay, and we didn't see a huge number of downgrades to FY27 expectations either. So it's solid, not spectacular, but solid, Vish.
Okay, well, may investors toast to their upcoming special dividend from Westpac if that's what happens. Finally, James, top buy call, top sell, and top sell coming out of this reporting season.
Yeah, I always hate doing these because it's always picking you get an egg on your face. I mean, I can only speak to what we've just done. So, I mean, we haven't really made a lot of changes across our portfolios this reporting season yet. We've sold JB Hi-Fi after their results, so we lost money on that one. We'd only bought it a couple of months prior. So, I'd call that as the sell, and the most recent buy we've made is Pilbara before their results. I thought they reported really well. And that's the last stock that we've bought there in our large cap growth strategy.
Okay. All right, James, thank you so much for your time. I really appreciate it.
Thanks for having me on, Vish.
No worries. To our viewers, I hope you enjoyed this video. Please don't forget to subscribe to our channel and give this video a like. From the Livewire and Market Index team, I hope you've enjoyed our coverage across CEO interviews, portfolio manager and analyst interviews, and of course the live blog that we do at Market Index. See you in February, and good luck with your investing.